All right, friends, let's move on. So we're now going to moving a bit away from the main subsidiary group parent staff. Okay. What if we are owning less than 50% or up to 50% of the equity shareholding, ordinary shareholding of another company? That's the situation of associates coming in. Okay. All right. So in terms of associates, what do we do? What do we recognize on the face of our statement of profit and loss? And what do we recognize as our portion on the statement of financial position? Okay, on the profit and loss, on the balance sheet, what do we recognize on the face? Okay, of it. All right, pretty easy, pretty straightforward. Okay, there's no element of consolidation here. Okay, we're just looking at our investment in associates and then our profit from investing in that associate. So these are the two things that we need. Okay, how do we calculate it? That's all. That's all. So in the tutorial question, you see two questions testing you on the subsidiary and an associate. Don't panic. Okay, don't panic. Simply, your main work, we are more or less testing or examining you, trying to see your understanding of all that we have learned. Okay, with the group account, with the parent and subsidiary situation. But again, for the associate, you just need two things, and work it out and present it, and you are gone. Okay. All right. I share my slides as we move on. I'll share my slides as we move on. Okay. So associates under IAS 28, associates. What do we do? Okay. All right. So I move on. So by the end of this, we want to simply define what or who an associate is and explain the principles, the mechanics, okay, how to use equity accounting to present, recognize, measure, and disclose this on the face of the financial statement. And then also preparing a consolidated statement of financial statement for a simple group, just a simple group, and then we can include the associate element over there. All right. Now we also want to prepare a consolidated statement of profit or loss for a simple group, and then we look at how we can include an associate. Okay. Any questions you find on this should be easy to work through. Okay, nothing is difficult unless you've not practiced, unless you've been missing the classes, you've not been attending to the slides, you don't have a textbook to read. Okay, you are okay. It depends. Anyway, it depends on the student. Let's move on. So an overview. So for the associate, the chart looks like we're gonna do a lot of things. No, we're not doing a lot of things. Okay, we are not. We're just looking at just some two elements. Okay. So first, statement of financial position. What do we look at? There could be intercompany transactions. How do we treat it? What is the rule? What about fair value adjustment of the assets? What is the rule about that? Okay. Now the standard workings are just three. Looking at post-acquisition profit elements and what is due to us as parents. Are there any impairments in our investment in this associate? How do we treat it? What if there's any trading between the parent and the associate? What do we do? Okay, those are the simple standard workings that we'll be looking at. Okay, again, the second portion where we're looking at statement of profit or loss. We will receive some dividends from the associate once you've invested. Similarly, what if they made loss? Any share we need to take. Okay, and then again, there could be impairments. How do we treat it on the face of the profit and loss, consolidated profit or loss statement? Any POPs, how do we treat it? And again, intercompany trading, how do we treat this? Okay, all right. So let's move on. Under IAS 28, it simply defines an associate as a company over which we have a significant influence as a parent. Okay, now significant influence here deals with not the power to control, okay, but the power to participate and make some critical decisions in their financial and operational activities. Okay, so the situation where you don't normally control, perhaps. Okay, sometimes it's tricky because significant influence can lead to control. It depends. If I'm the only person holding 40% of the shares, okay, and the rest the rest of the shareholders, okay, this 60% total remaining shareholding goes to different entities. Somebody's owning 2%, someone owes 10%, someone owes 20%. I'm the one with the highest shareholding. Sometimes it leads to control. Okay, it's quite debatable over here. But let's move on. Assuming all things being equal, that there's no control element here. Okay. So in terms of paragraph 3 of IAS 28 talks of this element of significant influence. Okay. Now, significant influence for the purposes of our computation and analysis here, we are looking at where we hold between 20 and 50% of the ordinary shareholders of the investee of the company the parent is investing in. Okay. Now, associates are accounted for using the equity accounting. Okay. What is equity accounting? Like the name sounds. Okay. Equity accounting. You're talking of you have an investment, an equity investment in an associate. How do I account for it? Two ways. Two ways that we'll look at. Okay. Let's move on. Now, in terms of the equity accounting, what we are saying here, the rule is that you don't control, you don't own more than 50%. So do not consolidate line by line. No. The value of the investment that you have the value of investment that you hold in the associate is simply a way for me to recognize my share of any post-acquisition profits that I get from this subsidiary, not subsidiary, so from this associate. Okay, same principle applies like the subsidiary. Okay, any post-acquisition reserves, retained earnings of the associate, I need to get my portion. That's it for the parent. Okay, again, for the statement of financial position, we need to include just one line item. You don't consolidate line by line and add the assets, their liabilities. No, just one line item where we'll capture it as investment in associates. Okay, we are going to introduce another working. Remember, so far for the standard working, and it doesn't follow in any particular order. Like I said, you could use a different approach to look at the standard working or the workings. That's okay with me. Okay, but for the sake of consistency, we are introducing the sixth working to look at the investment in the associate. All right. So the same thing will move on. Number one, we look at establishing the structure, like we know. Just a recap, okay? Number two, we end up looking at the net assets, okay, of the subsidiary, which we know, okay? And then number three, we look at our goodwill, okay? Number four, we look at our NCI. And then number five, we look at what? Our group reserves, okay? Our group reserves. Now, let us introduce a sixth one, number six, investment in associates. Number six, investment in associates. Okay, it doesn't follow any particular order. I mean, we just want to remain consistent. Okay. Now, again, in the statement of profit and loss, we include only one line item. And here, we only capture it as what? Share of associate profits. And we show it as one. And normally it comes below the profit from operations. Okay, after the operating profit, we bring it there as share of associate profits. Then we continue to look at the taxation and the rest. All right, let's move on. So as usual, the consolidated statement of financial position working, standard workings. Let's look at it. As I said, we established the structure. So in the structure establishment, we know that this is the group, okay, the parent group in the circle, okay. But there's one investment which falls outside the group, that is the associate. So this particular investee in which the parent has invested outside, which falls outside of the group. When we are consolidating, we don't need to consolidate him as part of the group. We just use one line item to describe them, okay, on the face of the account, okay. So it's not treated as part of the group, okay. So if there is any intercompany trading balances, what do we do? Do we have to still cancel it? No. No cancellation of intercompany trading. He's actually like an outsider, okay. So we need to maintain the relationship as if he's an outsider, okay, not part of the group, okay. So usually the grouping number five, the workings number five, which we know, the group reserves, the retained earnings, okay. We said 100% of the retained earnings of the parents, okay. If there is any other component of group reserves, keep it on the other leg, okay. And then we add the parent share of the subsidiaries post-acquisition reserves, okay. We know that, okay, from working number two, the standard one, the net assets, identifiable net asset of the subsidiary. We add that of the post-acquisition reserves, okay. Again, at this point, what we do is that we need to add the parent's share of the associate's post-acquisition reserve. The same thing moves along here similar, okay. Just that in workings too, you know, a lot of calculations go in and fair value adjustment and all those stuff, okay. All right. But here we're looking at only the post-acquisition reserves of the associate. If there is any goodwill impairment, we know. We subtract it from the parents' group reserves, okay? If there is any impairment, similarly, if there is any impairment in the investment in an associate, we subtract that one too. So the main thing we are introducing here under working number 5 is this and this. The rest remain the same. The rest remain the same as we have seen in the past, okay? And if there's any pop adjustment, whether the P is the seller or the associate is the seller, we subtract it, okay? All right. Then we get the reserves at the reporting date, okay? All right. So let's move on. Let's take the next one, the main one that we are concerned with in terms of investment in the associate, okay? So what is the cost of investment in the associate? That's the first thing we need to find out. The next thing is that we need to add the parents' portion of the post-acquisition reserves which we have acquired from investing in this associate. Add it. Add it. If there is any impairment in the investment of these associates, subtract it. We are dealing with this guy. So all profit we've gotten from him as a result of our investment, we add it. Our portion, our 20%, our 30%, we add it. If there's any impairment of investment, fully attributable to me, don't portion it, don't apportion it. So if I'm the parent and my investment in associate has impaired by 40,000, do I need to take a portion? No, everything that applies to me. So anything that fully applies to the parent, there's no apportionment. Knock everything off, okay? And then any pop adjustment, knock it off. Then we get this figure, which we report as investment in associate on the face of the balance sheet or statement of statement of financial position. Now, this adjustment, we are told, reflects the associate adjustment within the standard workings 5, which I showed you here. Okay, the same thing we find here are the same things we knock over here. We knock them off here. All right. A typical example. Let's take this example. Papa purchased 30% of Alpha share capital at a cost. So this is a cost of investment, 8 million. Okay. On 1st April 2017, at which date the retained earnings of these Alpha, the associate, was 4. Are we interested in their earnings at acquisition? Not really. We're only interested in the post, okay? As at 31st March 2019, okay, 2017 to 2019, 2 years later, we are told that the balance on Alpha's retained earnings was 6. So my post-acquisition here, which I am interested in as the parent, is what? My 6 million, all right, minus the 4 million. Okay, 4 million. That's what I'm interested in. And also, I'm being told that as a parent, or I don't want to use the parent here because it's not really a consolidation and parent subsidiary here. Okay, so the investor's investment in Alpha had become impaired by 200. Everything is knocked off. Okay, so I know the cost. Okay, and I know what I'm supposed to gain over here, 30% of my post-acquisition, and then I take off any impairment. There's no pop here. I don't see any intercompany trading here, so I will not worry my head. Simply, so the cost of investment is my 8,000, right? The post-acquisition 2 million, like I showed you, 30% of it gives you 600. Add it, and the impairment. Don't be tempted to find 30% of the 200. It is everything that belongs to you, okay, to the holder, to the investor. So knock everything off, and you get 8,400, which is presented on the face of the consolidated statement of financial position. Okay, that is it. The asterisk figures, I'm just giving you a note here that the other side of it goes to the working number 5, the group reserves. The group reserves. So you go to the group reserves, you add this. The group reserves, you subtract this. Okay, all right. Okay, that's it. So it is the parent's investment that is being impaired, like I said. So no need for you to apportion it, the 200,000. Everything must be taken off, the impairment. All right. Okay, we move on. Again, what about intercompany trading and fair values? That's why I like the Kaplan text. It takes you step by step to show you one step at a time, okay? Now, let's bring in the elements of intercompany trading and fair values, okay? Number 1, the rule. Do not eliminate balances between the associate and group, like receivables and payables. The associate owes the parent, don't knock it off. Don't subtract it. Okay, the parent owes the associate, don't knock it off. Treat them like outsiders. Okay, do not eliminate any intercompany trading between the associates and the group, like revenue and cost of sales. Don't subtract it. Okay, don't treat them like outsiders, as if you are working or dealing with outsiders. But then any dividends received from the associate, we must remove it from the statement of profit or loss. Why? Because at the end of the day, we end up consolidating all the profit, our share, within the associates. Okay, we'll look at an example. Any POP, any unrealized provision for unrealized profit is required. Okay, we adjust, we look at it where goods have been sold by the associate or sold to the associates, and these goods are still remaining in the stocks at the year end. We adjust. Okay, that is the only thing that we need to look at here. We adjust. Okay. Again, let's move on. So for the provision for unrealized profit, it's the same calculation that we know. Okay, we calculate it as if we are calculating for a subsidiary, but we only recognize the parent share, only the parent share. Okay, only the parent share. In the subsequent one, you realize that we include everything in. We include the full amount. The last example we looked, I remember it was 1,800. We include everything, regardless of the year, okay, whether it was mid-year or not. But here, we only recognize the parent's share, the parent's portion, okay? That's the next trick you need to look out for. In the statement of financial position, what we have to do here is that with the POP, with the provision for unrealized profit, we must reduce it from the group earnings, from the group retained earnings, from the group reserves. We must subtract it, okay? Again, we must reduce it from our investment in associates, which we calculated, okay? In the statement of profit or loss, we need to also reduce the share, okay, of associate profits. Okay, we'll look at an example. We'll take an example. You understand? What about fair value of an asset? So after we've bought it, some carrying amount were below the fair value. What do? We adjust, as if we are adjusting for a subsidiary, because this is an investment. I came in to buy your company, a portion of it. You told me the carrying amount is 10, only for me to realize that the fair value on the market is actually 12. It's some more or less like a gain to me. Okay, so the effect of this would include adjusting the post acquisition profits, okay, for fair value depreciation adjustment or any similar items which comes on. It could be current assets. Okay, all right, let's look at an example. So pan, date is hidden, let me check. Okay, so pan purchased 40% of Apollo's share capital at the cost of investment, right? 5 million on 1st January 2016. At which day the balance on Apollo's retained earnings was 3.6. I'm not really interested in the pre-acquisition profit, okay? On 30th June, let me see, from 1st January 2016, 6 months later, the balance on the retained earnings has increased. So my post-acquisition, which I'm really interested in, becomes what? My 4.2 million minus my 3.6 million, right? That's what I get, okay? But I can only take 40% of it, right? Of this. And Pan's investment in Apollo had become impaired, okay? The company, the parents, I don't want to use the word parent, but allow me to use the word parents. The parents' investment in the associate has actually been impaired by 150. Everything must be knocked off, okay? During June 2016, the mid-year, Pan sold goods worth 600 to Apollo, to the associate, on which he made a markup of 20%. At 30th June, on which it made a markup of 20%. At 30th June 2016, 1/4 of this still remain. Assume you don't know anything about this. What would you do? Simply, assume you don't know how to trade this. Simply, you would have ended up applying your markup, right? Of what? Of the 600. All right. At the end of the day, they said 1/4 still remains. If for nothing at all, remember this. Okay. If for nothing at all, remember this, that the goods, 600, a markup of this, but 1/4 still remains. It gives me my POP, right? It gives me my POP, at least for now. The next thing is, what then do I do? Do I just take my portion of 40% or everything? Okay, and that's the mechanics we've plotted here. For the POP, what do we do? The same calculation, but we only recognize the parent share. Okay, the parent share. Okay, and here the parent share is what, 40%. We are asked, calculate the figure for investment in associates. So we're looking at the balance sheet figure, investment in associate to be shown on pounds, consolidated statement of financial position at 30th June. Okay, all right. So the cost of investment was 5,000, right? The post acquisition, I think I showed the calculation, 4.2 minus 3.6, 40%. This corresponding goes into the group reserves. We add it. Impairment, the whole 150. 150, the whole 150, you don't prorate it, you don't take 40% for the parent. Similarly, the return leg goes into the parent's group reserves, okay? Then the POP adjustment, like I said, at least you know the 20 over the 120 times 1/4. If it was to be the group situation where we have a subsidiary parent, what do? Everything. But here, for associates, we only take the portion that belongs to the parent, okay? And then we knock it off. And this, again, the return leg goes into the group reserves, which we subtract. Finally, the investment in associates, we sum it up and we get this, which we need to present on the face of the statement of financial position. Okay, so like I said over here, when you get here, at least you are stuck. What do? Do I recognize everything? Or because it is an associate, oh, it's an associate, so I only need to recognize 40% of it. What I own, okay, only that portion. The rest is history. The rest is easy. Okay, so that's it. That's it. Again, what about the statement of profit or loss? Okay, I'm looking at my time. I think we can finish this quickly. Statement of profit or loss. Again, we need just a single line item to represent it. I said it. So how do we find it? Simply look at the parent share of the associate profit for the year. Parent share of the associate profit for the year. Any impairment in the investment of the associate, subtract it. Any POP adjustment like we have calculated, subtract it. And then we get a share of the associate profit, which we must show on the face of the consolidated statement of profit or loss. Same story, okay? Same story, okay? This figure we find over here would not be different from what we find over here. The same 10. The same 10 comes here, okay? Impairment for the year. The same thing as we've seen in the previous example, okay? So it's very easy to work this. Let's look at an example. PER purchased 30% of the shares on 1st January. On 30th September, PER's investment had become impaired. The whole of this, okay? During September 2016, PER sold goods 1.3, on which it made a margin. Okay, hold on. A markup, sorry. It made a markup of 30%. On 30th September, half of this remained in inventory. Half. In the year to this, 30th September, Apple made a profit after tax of this. After tax, okay? So that is after acquisition, 800. All items accrue evenly. Calculate a figure for the associate share to be shown. The associate profit, share of associate profit to be shown in PER's consolidated statement of financial position or loss for the year ended. Okay, we are not looking at the amount that investment in associate that we are supposed to represent. We just want the share of profits. Okay, so what is my share in the first place? Is there any impairment? Is there any POP adjustment? Okay, that's it. That's it. Okay, so in the first place, the share, we are being told at 800 for the whole year. One thing we should look at carefully, I've always told you, I'll look at the date. 1st January, and the year end is what? 30th September. It means we acquired this in the middle of the year. So it's not a full year. It means their year end starts somewhere September, 1st October. Okay? So 1st October 2015 up to 30th September. Okay? But we came in 1st January. So it means we only have 9 months to accrue. Always look at the dates. Don't be confused, okay? So we are being told that the post-acquisition reserves is this, okay? So we would have just applied our 30%, assuming it was a full year, okay, of this post-acquisition. Here we've been given the post-acquisition. We're not given the pre and then the full year for us to find out. No, we've been given a full post-acquisition, okay, times the pro rata, okay. So look at the date carefully, not to be confused, okay. So that's why we have 800 times 9 over 12 times 30% gives us this, all right. Impairment for the year, don't prorate everything. What was the impairment from the question? 80,000, subtract everything. Don't prorate, okay. And then for the POP adjustment, okay, for the POP adjustment is 1.3, we were told. A markup of what? 30, okay. So ideally you have your 30 over 130 times 1.3 million, right? Okay. And then times, we were told half, okay, times half, 50%, okay. If you don't want to find 50%, you can just write 1 over 2, okay, half of them, okay. Now the question is, do you leave it here? No. You look out for the parents' portion only. Parents' portion, which is what? 30%. Okay. So that we have our POP here, 1.3 over this, half of it, 30% gives you this. Then we get our associate, share of associate profit, which we need to bring right after our profit from operations. We show this line item. Okay, that is it. Quite easy. So we end here. So once again, I'll try and plug just 2 questions here. Since some of us don't have it, okay, I'll just pick 2 of these for the tutorial. Okay, for the tutorials, I'm not gonna reinvent the wheel. I'll just pick this. Maybe I'll adjust the numbers slightly, but at least for now, you have the text, I'm sure. Try all the TYU under chapter 20, okay, 1 to 6. Further reading, read chapter 20 in depth, have some time, and once again, it's a practical topic. Practice more, and you'll be good to go, okay? Practice more, and you'll be good to go. All right, so friends, I'm gonna end here. I've exceeded my 25 minutes, so I'm gonna end here. The next thing you see will be our disposal, straightforward, simple to do, and you'll be fine. Thank you, and I'll see you. Bye.